Okay, so we are going to start with the itemized deductions, that is section 1.4 of Reg 1. And this is basically the deductions from the AGI. Now, if we look at the stream of the taxes or the stream of the computation of the tax amount when we are filing the tax returns, we have the AGI after the incomes taken into consideration, after all the deductions for the AGI, then we arrive at the AGI. And from the AGI, there are certain amount of deductions which we call it as itemized deductions. Now, this is how the 1040 form looks like, where we have all the details of the wages, the salaries, the amount of interest and the dividends and all, which would be attached in a separate schedule, Schedule B. And from there, the amount would be carried forward. And then this, that is the item number 12A, that is the line item 12A, which we call it as a standard deduction or the itemized deduction, that is Schedule A, is something which is going to be the essence of section 1.4. And that's where we are going to deal with all the itemized deductions, inclusive of line number 13, which is going to be the qualified business income deduction, which is going to be in the end of this reading, where we attach a separate form 8995 to it for qualified business income deductions. Now, when we look at the deductions from the AGI, we can see that there are two types of deductions. Either ways, a person can claim standard deduction, which has the specified dollar amounts which can be reduced where you don't want to take the itemized deductions, or in case you don't want to opt for standard deductions based on whichever is more beneficial for the taxpayer, you would be going with the itemized deductions. And when it comes to itemized deductions, as the name suggests, it is itemized. That means it's broken up into 6 different types of deductions based on the nature of the transactions which is being done by the which has been done by the taxpayer in the financial year. That is the medical and dental expenses, the taxes, interest expense, charitable contribution, then casualty, and then you have the other itemized deductions. Now that is put in a mnemonic known as Mike takes interest in charity and casual outings. And then you have an additional deduction, which is not having any relevance to this. That is the part 2 of the deductions from the AGI, which is QBID, where you attach a form 8995 or 8995A to your 1040. Now, we're going to be starting off with 3 different subparts over here, one being the standard deduction, then comes the itemized deduction, and then comes the qualified business income deductions. When it comes to standard deduction, as I mentioned, that these are the specified dollar amount or the dollar limits, which is going to be straight away deducted from the AGI. Again, mark my words when I'm saying from the AGI rather than saying for the AGI. When it comes to for the AGI, that means these are those deductions which are going to be deducted from your incomes when you arrive at AGI. But these are those deductions which needs to be deducted after you have arrived at the AGI. These are the deductions which follow through. Now, depending upon the status of the taxpayer, if the taxpayer is an individual, that's where we come across these itemized deductions. So if it is an individual and he's single, or he is an MFS, or he has an MFS status, that is married filing separately, then the person can claim $12,550 of deductions. Let's say his status is head of the household, then he can claim a deduction of around $18,800. That's a flat deduction, straight away going to be deducted from the AGI. When you are as an individual, you are married filing jointly, having an MFJ status, or if there is a qualified widow or widower, then you have 25,100. Now, interestingly, one thing you can just have or use this trick to remember is 25,100 is nothing but 12,550 times 2. And that's what is the best way of remembering few of these numbers when it comes to, additional, or I would say accelerated deductions for few types of taxpayers who are elderly or blind, or the situation where they're elderly and blind. So that's where things become a little bit more complex when you come across some additional standard deductions. When you come across an additional standard deductions, you just need to make sure that whether the taxpayer is falling under the bracket of single or MFJ, because there are the two categories of additional deductions where the taxpayer can claim. So either the taxpayer is falling, again, let me repeat, either the taxpayer is falling within the bracket of 12,550 or falling within the type of 25,100, because the status over here is different. The taxpayer status is very much different over here. Now, if we are looking at the single taxpayer, or let's say he's married filing but separately, okay, so in that situation, if the taxpayer, he or she, is either 65 or blind, that means if he satisfies either of one of these conditions, right, either he is 65 and above or he or she is blind, then an additional deductions over and above 12,550, you get an additional deduction of 1,700. And the fun fact over here is that if the taxpayer is 65 and blind, that means there is a plus over here. That means if he is 65 as well as blind, this amount over here just doubles into 2. That means if you qualify either this or this, then you are getting an additional 1,700. If you qualify both, then you are getting a deduction of around 3,400. That's just twice of this. Now, when it comes to MFJ, that is a little bit a bit of an issue for you to remember, because there is no linkages between these two numbers. So yes, if it is an additional deduction, you need to make sure that if it's 65 or blind and single, then the figure is 1,700. If it's 65 and blind and if it's MFJ, then the figure is 1,350. Right? So once you remember 1,350, all these figures basically becomes very easy for you to remember. Now, I'm going to show you how. Let's say, for example, the taxpayer is married, filing jointly, then at that situation, only one spouse, right? If just one person of those two people, if there is one person or one of those two, one of the spouse is either 65 and above or blind, then he gets or she gets a deduction of around 1,350. Now, what if the other person or the spouse is neither blind nor 65 and above? Let's say he is 65 and below and he's not blind as well, then he gets none of these, right? Now, let's say, for example, there is a spouse who is 65 and blind and filing jointly, not separately, then he gets qualified to get an additional deduction of around 1,350. Now, let's say, for example, the same person is 65 and blind. Let's say, again, there is a husband and wife, and the husband is 65 and blind. Let's say, for example, the wife is fine. That means she is less than 65. She is not blind. That means you get an additional deduction of around 2,700 over and above 25,100. That's why I have a small tip over here. This figure, which is within the green box, is per spouse. This means it is per one. This is for one spouse, right? If he or she qualifies, that means the other one is fine. I mean, the other one, when I say it's fine, that when I say the other spouse is fine, I mean she's less than or he's less than 65 years and he is fine. I mean, he's not blind. That's it. And now, if both the spouses qualify this situation, now here things get a little bit more interesting. This 2,700 is nothing but the double of 1,350. And this 5,400 is nothing but the double of 2,700. Or this 5,400 is double of 2,700. Just the way this 2,700 was the double of 1,350. Now, there could be a few ways in which you can derive the relationship, but then more importantly, the most important thing over here is remembering these two figures, because once you understand the logic and once you remember these two figures, you're good to go. To be honest, you're good to go. Now, there could be some dependents, right? So there could be some dependents who can get an additional deduction, right? Let's say, for example, if the standard deduction is greater than 1,100 or the earned income plus $350, whichever these conditions, whichever is higher, then yes, you can get the standard deductions as well. That is 1100 or the earned income plus 350, whichever is higher, you get an additional deduction over and above if in case you have the dependents, right? Now, moving forward, this is how Schedule A looks like. This is basically the for the personal expenses. Now, this is not applicable to the corporations. May that be 1120C, 1120S, or 1065, or foreign corporation 1120F. This is not applicable for any of the corporations. Now, this is purely restricted to 1040s. That's why this is a Schedule A, which is separately attached to 1040. Now, how does this schedule looks like? It's more or less looks very much similar to the having the same items which you had seen in the first page, that is over here. That is Mike takes interest. Now you have all these things over here as well. So let's say, for example, Mike takes interest. Now, Mike stands for medical. Now you have the medical expenses over here. We would be dealing with all these things in details in a while when we would be covering up these stuffs in independently, separately. But yes, then you have these items over here. You have the medical expenses, which has been paid by the taxpayer. If there are any state and local taxes you have paid already, you get a deduction. You get a deduction for the state and local taxes. May that be the either sales tax or the income taxes or the property taxes or the real estate taxes, or in case you have already paid any kind of a foreign taxes, then you get a deduction over here. And we would be dealing with the limits of around, for whom it is 10,000, for whom it is 5,000, and when is a situation where you can get a deduction up to 5,000 and or 10,000. All these things we would be discussing this in a while. Now, the next item which we have is interest, which you have paid. Now, when it comes to the interest, we are talking about the home mortgage interest. There could be some investment interest as well. Now, mark my words, investment interest is it's very much different from the business interest expense, which could be availed by the taxpayer. Now, don't get confused between 163J business interest expense compared to investment interest expense. Now, these two are different. Now, we would be discussing that again, just for your reference. We attach form 4952 over here. That is an additional details of the investment interest. And now, what could be the limits of investment interest and all these things would be also covered shortly. Now, then comes the charity. That is, let's say, for example, if you are making any charitable donations beyond and over and above $250, or in case of like $500 or $5,000. So whatever the type of deductions may be, whether it is in the form of short-term property, whether it's in the form of a long-term property, whether it's in the form of a cash, whether it's in the form of the check, and in what cases you need to maintain or you need to keep the receipts. All these things, again, we will be discussing in a while. Then comes the casualty losses. Now, make sure that you don't get tricked over here when the question says that the casualty and theft losses are not arising out of the Fed declared disaster. So it has to arise from a Fed declared disaster. Again, as I said, that these are the reference forms which someone who is working practically in 1040s would be well aware of what 4684 is, and then there could be some set off and carry forward of the casualty losses against the casualty gains and all, and there could be $100 deductions as well. There could be a 10% of AGI deductions as well. Now, all these things would be again covering in a while. Now, then comes the outings. That means you go out, you do the gambling, and you lose. Let's say, for example, there is a gambling loss. Now, when it comes to gambling losses, now there could be couple of other itemized deductions. As the name says, other itemized deductions. There could be few other itemized deductions which you would be terming it as gambling losses, or let's say you can say that personal property losses. There could be any other type of losses which would be covering. Then there would be the list of the type and the amount which we need to mention it in Schedule A. Now, when we are getting into the medical and dental expenses, now there are a few things over here which I want to make note of. Now, first of all, let's say, for example, now just ignore all these extra tips which is written over here for the time being, and just let's focus on the script which is already printed, not the ones which is written by me, but the things which have been already printed. Now, what could be the medical and the dental expenses? Now, whenever the taxpayer is making some payments. Now, the payments can consist of a list of variety of items which are present over here, but you are not required to know almost everything, but you should understand the essence of the transaction and then check and then re-verify whether it is deductible or non-deductible. So I'm just going to talk about the expenses for a while. And once I just give a brief on the expenses for a while, then I will talk about the accounting, about the calculation, about the computation. Now, when it comes to, the deductible expenses, now imagine there are certain type of expenses which is I do think it is considered to be non-deductible. It's my personal opinion. Now, I think it is non-deductible just because I feel that it is not essential. Now, let's say, for example, prescribed drugs and medicines are essential as compared to non-prescription drugs. Now, that's something which I don't think it is essential because it's not prescribed. So, hence, the prescribed drugs and medicines, insulin, over-the-counter medications is something which you need to remember. Okay. And let's say, for example, menstrual products and sanitizers, and then you have the sanitizing wipes, which is required for COVID and all. Now, these are the things which is highly essential, which is what I find a way of remembering these items to be considered to be a deductible expense. But then there are certain other types of items, let's say weight loss programs. Now, that is not something which I consider it's really important, or which is really going to be prescribed by the doctor, or let's say hair transplantation. Now, that's something. So from here, like, let's say, for example, weight loss programs, supplements for looking good, hair transplantation is again for looking good, health club is for looking good, personal hygiene and ordinary personal expenses is again something which it's very much individual. It's not something which can ever be prescribed by the doctor. Or let's say, liposuction. Now, when I came across this term, it was like I had to call one of my friend who is working in the healthcare and ask him, what on earth is liposuction mean? And what he explained me is that it is a form of reducing the fat. Now, at times it becomes a little bit dicey that the question may not be straightforwardly saying you that now there was a surgery which the person went through in order to reduce the fat, in order to look good. But no, they may use the term liposuction, which can be a little bit common in most of the in most of the times when I have seen. So yes, then there you go. Cosmetic surgery is also one of those important items which you need to remember. Again, somehow relates to a non-prescription kind of a drug, or it's something which I would say it's a weight loss program. It's something which leads to your personal benefits. It's not something which is really, really, really important for you to survive. It's not like, you can still survive without a cosmetic surgery. That's how it works. So there are a few other important items, let's say, for example, when you come back to the deductible expenses, yes, there are certain things which is very much important. Let's say, for example, weight loss programs, which is very much required, in order to treat obesity. Now, this item over here is not to look good. Now, if there is a certain situation where the taxpayer undergoes goes for the weight loss program, and that is basically prescribed by the doctor, and that is just to treat an ailment, just to treat a disease, then that is going to be deducted. But weight loss program just to look good, never going to be a deduction, right? So this is how you gotta remember. Let's say, so now again, when you're looking at the cosmetic surgery, now when it comes to cosmetic surgery, it's something which I would say that this is going to be done in order to look good. But if there could be even a cosmetic surgery in order to cure a kind of an accident, injury, or maybe, kind of a stuff which is very much required by the doctor, yes, that is deductible. Again, there are a few things. Let's say, for example, medical goods, like I'm wearing the glasses, my teeth is false. Let me be honest with you. My front 4 teeth is false. I have a fake teeth. Now, let's say, for example, you have a false teeth. You're wearing eyeglasses. You're wearing hear aids. Now, that is something which is suggested by the doctor. That is something is deductible, right? But then now when you're coming across this non-deductible, you have the, like funeral, you have the burial expense, you have the disability premium. Now, let's say, for example, some of the taxpayers, they take an insurance in order to protect their, to protect their family income, in order to protect their earnings in case anything happens to them. Then let's say, for example, disability earnings, accident earnings, right? So if you are making any premium payment, we're not talking about the incomes which you're getting. We are not talking about the, the amount which you're getting back in case something happens, God forbid. But yeah, let's say, for example, you're making some premium payment for that, for such kind of an insurance, and that is not deductible because that is not something which is really essential, I would say, right? Stop smoking programs is deductible. So travel cost and medical care. Now, these are things you got to make sure that you read it a couple of times, then it's going to grow on you. And right now, when it comes to the calculations, now you have certain expenses which has been paid. You have certain expenses which has been paid. Just give me a moment. Now, let's say, for example, you are making a payment of around $50, right? You're making a payment of $50. And that is the payment which you have made in check for all the deductible expenses. Now let's keep it very much simple. Let's say the non-deductible expense total sums up to $70. Out of those, non-deductible is $20, which you cannot claim as a deduction, whereas $50 is something which you got to claim as deduction. Now that is the deductible amount, which is $50. Now, let's say your employer has reimbursed $10. Now, how much is deductible? $40 is deductible, right? Now, from the $40, let's say, for example, your AGI is $100. Now, what is the limitation of this 7.5 over here? When it comes to $7.5 limitation, what you see over here is that you can deduct up to 7.5. But that means I would, if I say in a layman terms, it is 7.5% of your AGI will eat up your deductions. So right now, you're going to be enjoying a 40. That's what you think, that you're going to enjoy a $40 of itemized deductions from medical and dental expense. But is that so? No. Why? Because there is a limitation of 7.5% of the AGI. That means, which is what I have written over here, is you got to make sure that all the deductions are reduced by 7.5% of the AGI, which is nothing but a bad news for the taxpayer. That means how much is 7.5% of this? It is into 7.5% goes to $7.5. That means your deductions right now will be 40 minus 7.5, which is 32.5. You cannot claim $40 deductions. Rather, you can claim the deductions to the extent of 32.5. Right? So I hope this is where we can stop, and the management can revert back to me on this. Thank you so much.